if you implement large tariffs, and then especially if you get in counter tariffs, that's basically a big global tax increase. Um, and if you don't meaningfully get through major tax reductions, so the Trump administration has talked about reducing income taxes, corporate taxes, locking in some of the prior taxes, that kind of thing. Um, but at least at the current time, generally tariffs are coming first. We don't yet fully know what the other legislation is going to be. So a risk is if you jack up tariffs and then other countries jack up tariffs and then there's not huge tax reduction elsewhere, then it's a really big tax increase. And that can increase the odds of recession, or makes business planning a lot harder. You know, if you're someone handling all these international contracts and you don't know if your specific industry or your specific country is going to be affected, everything's kind of in limbo for the next couple months in any given area. It just increases frictions and planning complexity, which can get in the way of kind of like how they want to decrease regulations to make things more efficient. Well, on the other side of the coin, a period of uncertainty is a period of inefficiency in a way. So that's just like an ongoing risk in the space. I think that the biggest question is how hard they're going to push on it, because I think they absolutely could impact the economy. If you did very large tariffs,
Hmm.
kind of across the board, let's say hypothetically, you just put 20% or more tariffs on like everything, or things like that. That's a pretty meaningful tax increase. And most like any one thing could be changed pretty easily, domestic versus international. But when you're moving entire supply chains, so all the electronics that are made in China and all these other things made in other countries, a lot of them are energy intensive things to be doing. A lot of them are toxic, the rare earth metals and things like that. A lot of these are slow moving things that have various complexities and time to reshore. And then they come with a cost because they're not here for a reason. It's generally because they're more expensive to make them here. And so by moving them here, either because of tariffs or otherwise, you're generally bringing them into a higher cost jurisdiction, which then competes with the administration's goal of reducing inflation. Now, there's still other levers they can pull for reducing inflation, like decreasing the regulatory burden, making sure energy is flowing well, that kind of stuff. But so it's not to say that those are impossible, but they are somewhat in conflict, because tariffs are effectively a tax increase. And then even if you dodge the tariffs by bringing things more domestic at scale, not just like one thing here or there, but actually at scale, like moving hundreds of billions of annual production of things more domestically. We have the highest healthcare costs in the world. So any sort of manufacturing worker, you're basically as an employer, you're paying some of the highest healthcare costs in the world for them, and various other frictions and costs. So there is not really a free lunch with some of this, even though I think some of the priorities make sense. If you put really huge tariff taxes on a broad number of things, not just like targeting one country or a couple different industries, but if you just put up massive tariff walls and you're trying to relocate a couple $1 trillion worth of an industrial base, that is friction. That takes time. We This whole kind of modern period, like they call it the past 30 years, we've had a bigger than average gap between money supply growth and price inflation of consumer goods. And part of that is because we've had globalization. So after NAFTA opened a lot of things, as well as the whole fall of the Soviet Union, the opening of China. Basically, we took all these kind of pools of labor, resources, connected them with Western capital, and kind of spread supply chains to the cheapest cost production. And there were losers to that. Like if you were, industrially focused in the U.S., you were generally a loser of that whole trade. Consumers, on average, were winners. Wall Street was a big winner. Government's a big winner. But basically, this was a structural disinflationary force that we're now, for pretty good reasons, talking about unwinding. But it's always important to then be aware of the other side of that, which is say if we are purposely trying to get companies to make things in higher cost jurisdictions, that generally comes with frictions. Now, there's different types of inflation. I mean, one is in order to have like a sustained increase in prices across the board, you generally need money supply growth. That's kind of the core of what inflation is. Um, Other things come down to where is like the share of margins and capital coming from. So in recent years, recent decades really, in the United States, there's been more share of the economy going toward corporations and corporate margins and less toward labor wages because now labor has to compete globally when before they didn't really have to as much. And so that's been generally negative for wages, really good for corporate profit margins. And so as you try to pull some of that back, it could be good for wages, which I think a lot of people were in favor of. But generally speaking, someone's paying that cost. Consumers are paying that cost. Company profit margins are potentially paying that cost. It depends on the specific tariff, the specific size, substitution options. But generally speaking, you're either taxing stuff that stays foreign, which is higher prices, or you relocate to a higher cost area, which has benefits, but then generally comes with higher prices. So there is potentially inflationary effects, but only if this is done at scale. Not like specific industries or little like small tariff wars are generally not that inflationary. When they do QE or QT with non-bank entities, that does affect broad money supply. So some of that reduction there in 2022 was related to the Fed doing quantitative tightening. And their ongoing quantitative tightening is also somewhat suppressing current M2 growth, but they're by no means the only variable. Other variables include things like how much are banks lending, including the U.S. fiscal deficit and are banks buying it or are non-banks buying it. Those are all factors that determine this. And so you'll generally see a lot of assets were correlated with that over this period. Now, it's not to say that that correlation exists strongly in every environment. So on that chart, for example, it's a smooth upward trajectory all through the 2010s in terms of money supply. And yet we know there were some pretty big bumps along the road of things that were happening in that time. Like when Powell was hiking rates back in 2017 and then ran into like liquidity issues and corporate credit and then got more dovish. There were other factors impacting that. Also, the 1990s had very low money supply growth, and of course, that was a very good time for U.S. equities. That was like the peak bullishness, peak demographics, pretty high monetary velocity, so the economy is doing a lot of work with that money. And so it's not to say that that is the only variable that matters across time, but that especially in an environment where fiscal's running hot. So loose fiscal policy, generally stimulatory fiscal policy, but then tightening Fed policy. When those things change relative to each other and they're both relatively big factors, that makes a big difference. So in 2022, both the Treasury and the Fed were generally draining liquidity. That's why that was such an awful year for pretty much every asset. And then we started to see the Treasury offset some of the Fed stuff after that. And so at least in this environment, I do think various measures of broad money supply and adjacent types of things are actually pretty likely to remain correlated with asset prices. All else being equal, that would be tighter monetary policy at a time when there's not really as many offsets anymore. So yes, I would think that'd be negative for asset prices. If anything, they're going to go in the other direction. So they've already tapered, like they already decreased the rate that they let treasuries mature off their balance sheet. So they've slowed down their quantitative tightening. Probably the next step is to slow it down more or stop it altogether, which we might see by the end of this year. And over the past couple of years, we've had the $2 trillion reverse repo facility drain back into the system and offset their quantitative tightening. That's now down to like 100 billion, so that can't happen again. And so there's not that many other sources of liquidity. So yeah, if the Fed got super aggressive with balance sheet reduction, I think we probably would see some challenges in the treasury market, and then that would then bleed into other markets, and we probably would see a backpedaling by some of these entities. Yeah, anything that increases regulatory certainty is helpful. So I personally speak to a lot of large corporate entities or banks, and they've made it clear that the recent kind of like the combination of the spot Bitcoin ETF being allowed and then also the Trump victory just increased their confidence that they have a pretty long window now of the government not really being an issue with them holding Bitcoin. So any sort of tail risk concerns some of those had have been reduced. So that other if that was someone's hang up for not buying, now they can buy. And I think that's why we've seen liquidity's not really gotten much better since the election, but certainly the regulatory outlook for the space has gotten better. And so that's why I think we've seen a pretty rational price increase. If the US does a really big Bitcoin purchase, that's obviously generally good for Bitcoin. If they just do a small purchase or they kind of keep the coins they already have, then maybe that's not a big factor. But if they do some of the more aggressive ones, that could be big. If other central banks or other sovereign wealth funds decide to accumulate meaningful positions, that matters. There's a little bit of a spreading of corporations buying Bitcoin. And so to the extent that that accelerates or decelerates, that's really meaningful for price. So there are tons of non-liquidity things like they're kind of more cultural or regulatory things that can happen. And then the other thing I look at is mainly like just on-chain valuation metrics to look for problem areas. My favorite metric is market capitalization compared to on-chain cost basis. And right now that's pretty middling. So it's not as high as it historically has been during major market tops. That's not to say that every cycle has to be the same. They could certainly change. But most of those like types of kind of fundamental valuation indicators or like kind of euphoria indicators are still not really flashing red. At a couple times they've kind of flashed like yellow, but they've not really been flashing red, which is another set of things that kind of gives me confidence for the next 18 months or so. It's been positive to see this consolidation kind of work its way out. I probably thought the consolidation would last a little longer. I'm glad it's not because I'm long gold. Generally speaking, we've seen a little bit of rotation in buying. So before it was mainly foreign central banks and people in China and elsewhere buying. Now I think we're seeing a little bit more North American purchases that are supporting it. And a main difference between gold and silver is a lot of large entities like central banks buy gold, whereas they don't really buy silver. In addition, generally speaking, if someone is into like hard money and precious metals, gold's the low volatility one, and then they get into either silver, platinum, or miners for their higher volatility exposure if they're bullish on the space. And now, with the size of Bitcoin and to some extent other cryptocurrencies, that market's more fractured now. So I would say that Bitcoin has not really competed with gold too much because it's not really competing with the same types of buyers. Now, around the margins, it has competed, but I would say it's competed with silver and gold miners more because you're capturing kind of a hard money enthusiast with high volatility tolerance. That's a little bit more of a competing market.